Well, a lot of conversations will continue. And that being said, we are now about to deep dive into our next keynote address. And this is where we will be hearing from Mr. Francois Villeroy de Galhau, Governor, Banque de France. Now, we were to have his august presence here at GFF 2025. Unfortunately, while he couldn't join us in person, we do have his message in a video format that we'd like to share with all of you. In fact, I'm going to urge once again, everyone, please take your seats, because up next we have a video message coming in from Mr. Francois Villeroy de Galhau, Governor, Banque de France, NPCI. So this is all about from Paris to Mumbai, connecting continents through finance and technology. So let's deep dive into this message.
I'm delighted to address this audience at the Global Fintech Festival of Mumbai, a city that embodies the momentum of India's economic development, and above all, the energy of its technological dynamism. I warmly thank Governor Malhotra for his friendly invitation. New technologies, and I will not speak only about AI, are driving profound changes and challenges, and the financial sector is no exception. In our current environment, payment systems have become more than just a technical issue. They are the cornerstone of our economy's stability, sovereignty, and a bridge to our economic partners. Today, I will focus on how we can accordingly reinforce global financial interconnectedness. I will therefore first discuss how, in the short term, innovation can help interlink legacy fast payment systems and connect different economic areas. I will then turn to the medium and long term, where innovation can strengthen both monetary sovereignty and global integration. Let me start with the short term about interlinking and connecting. Cross-border payments deserve our consideration, not only because of their size, but because of their role. Quantitatively, their importance is striking. They are on the rise globally. They amounted to 194 trillion US dollar last year, and are expected to reach 320 trillion dollar by 2032. But what matters even more is their purpose. They connect our firms and our markets. They underpin trade and investment. They sustain economic development through remittances, which remain vital for many emerging and developing countries. Yes, cross-border payments today are still exposed to high costs and low speed, to heightened fragmentation risk, which stem from sanctions, regulatory divergences, and siloed technological development. And these risks are unfortunately not theoretical. Since 2011, due to de-risking strategies, the number of active correspondent banks has fallen by almost 30%, 30. Hence, the G20 roadmap, with its 27 horizon, aims at tangible achievements to make these cross-border payments faster, cheaper, more transparent, and more accessible. A key avenue, therefore, is the interlinking of fast payment system, FPS. They are already functional in over 75 countries. And both India, with UPI, and the Eurosystem, with STIPS, are leading this transformation. But the next step is to deliver on concrete interlinking projects, whether bilateral, between UPI and TIPS, which I strongly support, or multilateral by exploring the BIS Nexus project. These are paving the way to full interoperability of end-to-end payments, including with European front-end solutions such as private solution, Wero or Bizum. Regulatory and AML frictions are often seen as holding back cross-border payments. True. Yet technology can contribute to overcoming them, as illustrated by the BIS Mandala project, to which the Banque de France contributes. This shows a very important lesson, that security and efficiency are not mutually exclusive. With the right innovations, we can achieve both. I now come to medium and long term. How can innovating in payments strengthen sovereignty and global integration? We are all aware that two structural transformations are underway: the digitalization and possible tokenization of payments, and the rise of distributed ledger technologies, DLT, including blockchain. Both risk weakening our sovereignty and our access to central bank money, but by taking the best from the right technologies, we can turn this challenge around and build a safe and innovative financial future. If I look at the retail space, for the first time last year, card payments overtook cash payments in France. This reflects the broader digitalization of retail payments, which are increasingly reliant on international card schemes, accounting for 69% of card payments in the euro area, and playing obviously a central role in cross-border transactions. Yet, 60% of French people still consider it important to have the option to pay in cash, underlying its enduring role in our societies. If I now come to the wholesale sphere, DLT and blockchain underpin both the growing tokenization of financial assets and, yes, the development of stable coins. Tokenization has a strong potential to improve transparency, to ease data reconciliation, to reduce costs and inefficiency by optimizing processing along the settlement chain with smart contracts. DLT is also a powerful tool to automate, secure and speed up KYC and compliance checks. Stablecoins are themselves a direct application of blockchains. Their primary use today remains concentrated within the crypto ecosystem. They are nevertheless progressively expanding into mainstream applications, notably tokenized finance and cross-border payments. And they could expand, possibly tomorrow, to domestic use cases. Their rapid growth, we still have an outstanding of $250 billion this year, overwhelmingly dollar-backed, strongly promoted by the US administration and its recent Genius Act, creates a serious risk outside of the US of a de-sovereignization and a privatization of the currency. I will come back to it. While heightening financial stability risk, as well as AML concerns, the growing use of stablecoins could also weaken monetary policy transmission. These two transformations, retail digitalization and blockchain innovation, both raise the same fundamental issue: how to preserve the role of central bank money in a rapidly changing ecosystem. Central bank money is the anchor that no private arrangement, whatever technological innovative it is, can replicate. Central bank money is the ultimate risk-free settlement asset and the foundation of trust and stability in the financial system. Hence, the Eurosystem's response to the rise of dollar-backed stablecoins is twofold. On the retail side, it is preparing, as you are aware, the digital euro, a true digital banknote plus, designed to bring together the features of cash and the digital era, offering privacy and resilience, including through its offline functionality. And as a form of, I would say, digital public infrastructure, it will catalyze private innovation through a public-private partnership with European commercial banks. If I now come to the wholesale side, our Eurosystem is developing tokenized settlements in central bank money, with an initial solution for banks and markets as early as next year, what we call the Pontes project. So, central bank money will remain the anchor, but it must evolve and coexist with tokenized commercial bank money. Public and private money have always been complementary, and this balance must be preserved in the digital age. This raises the question of tokenized bank deposits and tomorrow, possibly euro-denominated stablecoins. They can provide new, efficient forms of private money. Let me add one word on artificial intelligence. AI is emerging as a transformative force already applied in areas such as credit assessment, fraud detection, and supervision. But AI may also contribute to the amplification of some financial vulnerabilities. For example, AI market concentration could increase the risk of dependence on third-party players. The use of the same type of tools could also amplify herd behavior, resulting in greater volatility and procyclicity. To attain our objectives while curbing these risks, we need a trusted AI. The European Union has proven itself a pioneer in this area by adopting the AI Act in the summer of 2024. And again, innovation and trust can go hand in hand. Let me conclude. Financial innovation is not a mere technical issue. It is about core values, stability, sovereignty, global integration. By interlinking fast payment systems, by adapting central bank money to the digital age, we ensure that innovation remains a force for openness and trust in the global financial system. Let me quote, to conclude with, the French author Romain Rolland, not a specialist of payments, but Nobel Prize winner in literature and admirer of Mahatma Gandhi. He once wrote, I quote, "The greatest human ideal is the great cause of bringing together the thoughts of Europe and of Asia. The great soul of India will topple our world," unquote. Today, following Romain Rolland, from Paris to Mumbai, this dialogue endures, not only in culture, but also in finance and technology. Thank you for your attention.